You know that feeling when you hear an investment pitch that just sounds a little too perfect? Well, today we're going to dive into some key items to consider when thinking about a pitch on downside protection ETFs. I mean, really stop and think about that for a second. Imagine riding all of the incredible highs of the stock market, but having this magical safety net that catches you every single time things start to dip. It's the ultimate dream for pretty much any investor, right? But is it for real? Let's find out. You know, at the end of the day, this whole thing taps into a classic conflict every single one of us feels. We need our money to grow to hit our goals, but man, we absolutely dread those sharp, sudden market drops that can just erase months of progress in the blink of an eye. For decades, the playbook was simple: mix stocks and bonds. The whole idea was that when stocks took a nosedive, your boring old bonds would hold steady, acting like a shock absorber. But here's the thing. Since 2021, the game has changed. We've seen stocks and bonds falling at the same time. All of a sudden, that trusty old safety net feels, well, not so safe. And that's creating some real anxiety and a huge appetite for a new kind of solution. And right on cue, a new product shows up that seems like the perfect answer: the Downside Protection ETF. Now, an ETF is just a fund you can buy and sell on an exchange like a stock. And Downside Protection ETFs come with a killer promise: get the market's growth, but minimize the risk. So how on earth do they pull this off? The secret here is called an option collar. Now don't worry, you don't need to be a Wall Street wizard to get this. The easiest way to think about it is like putting your investments inside a room. The fund manager builds a protective floor, let's say at a 0% loss, so you literally can't fall through it. But, and this is key, to pay for that floor, they also have to build a ceiling, which caps how high you can go. And this slide lays out that trade-off perfectly. If you're in a regular S&P 500 ETF, the sky's the limit on your gains. But there's also no floor of your losses. With a downside protected ETF, you can get that awesome 0% floor, which feels great, but the price you pay is that you give up any potential gains above the ceiling, say 7% in a year. So that protection definitely comes at a cost. So that promise of a perfect floor sounds amazing, but it comes with some really important fine print. We've got to take a much closer look at what's actually going on. The marketing pitch is just so simple and powerful because of this idea that you won't lose money over the product's 1-year term. I mean, what's not to love? It sounds foolproof. But, and this is a huge but, that promise is really only ironclad if you buy the ETF on the exact day the cycle resets. What happens if you buy it after day one? Let's just walk through a quick example. Let's say the ETF starts the year at $25. That's the floor. If you buy right then, perfect. Your floor is your purchase price, no downside. But let's say the market rises and you jump in 6 months later when the price is up to $26. Here's the catch. The protected floor is still back at $25, which means your investment can actually fall almost 4% before that protection even begins to work. And this quote says it all, doesn't it? The second that ETF price climbs above where it started, that promise of 100% protection for any new investor is no longer valid. When you buy is absolutely everything. And it's not just the downside that has a catch. Let's talk about that ceiling again. So the ETF caps your gain at around 7%. But historically, when the stock market has a good year, the average return isn't 7%. Over the last 100 years of rolling 12-month returns, the average positive return of the S&P 500 was 18%. You're potentially leaving a massive amount of growth on the table just to buy that floor. Now, this is what I find really fascinating. How often does the market actually end up in this ETF's perfect little zone? Well, looking back at 100 years of data, a whopping 58% of the time, the market blew right past that 7% cap. In 29% of the time, it dropped below the 0% floor. So when did it land in that narrow little sweet spot between 0% and 7%? Just 13% of the time. That's it. This isn't really participating in the market. Instead, it's like a bet where you're probably going to hit the ceiling or the floor. So this forces us to ask a really important question. If this thing doesn't really act like a normal investment or a normal stock investment, then what is it? Is it really a replacement for your growth investments, or is it something else entirely? When you actually put it side by side with a genuinely safe asset, like a simple one-year treasury, the picture gets a lot clearer. The treasury's principal protection is very strong. Its return might be lower, but it's also a lot safer, and the complexity is practically zero. The ETF, though, offers conditional protection, a variable return, and a whole lot of complexity. It starts to look less like a stock and more like a complicated, less certain version of a bond that has a slightly higher return. And that leads us to this one single number, 36%. Based on historical data, that's the chance more than 1 time out of 3 that you would have actually been better off just buying a simple, boring one-year treasury at the current rate yielding 3.9% instead of this complicated ETF. For a product that's sold on the idea of safety, that's a pretty big risk of coming up short. At the end of the day, it just proves that timeless saying in investing, there really is no such thing as free lunch. There's no magic bullet. If you want to reduce your risk, you are always going to have to give up something potential. You're always going to have to give up some potential reward. These ETFs aren't a freebie. They're a choice, a trade-off. You're giving up huge downside for a very complicated and conditional type of safety. And so, that really leaves us with the final question you have to ask yourself. Is that psychological comfort, that feeling of being protected, worth the cost of all this complexity and all the growth you might miss out over the long haul? That's the trade-off, and it's a really important one to think about. I want to note that this video is purely informational and should not be taken as a recommendation. If you're interested in discussing your own investments in more detail, reach out to our team today and we'd be happy to connect.